So, Cleveland-Cliffs narrowly beats expectations this quarter, despite taking an absolute $80 million punch to the gut from Mother Nature. It is honestly kind of impressive.
Right. Impressive is one word for it. The CEO just called it unlucky. But considering the volatility in the steel market right now, they survived it.
They really did. And welcome to Earnings Unscripted, where we try to make sense of that survival. Today is April 20th, 2026, and we are looking at Q1 for Cleveland-Cliffs, ticker CLF. Also, a quick reminder that this is just our personal take, so please do not use this as financial advice.
Yeah, I would not recommend trying to time a stock that trades like this anyway. Q1 was pretty brutal for them overall. The stock slid roughly 40% over the quarter. Then the earnings drop. It gaps down at the open to about $8.94 and immediately just rips. Rallies almost 9% intraday to finish basically flat against the prior close.
It is so bipolar. Like, the market saw a net loss and decided to just aggressively buy the dip.
Well, yes and no. They saw the top line. Revenue came in at $4.92 billion. That is up 14% sequentially from Q4.
Okay, but they did still post a loss. Diluted EPS was negative 42 cents.
It is a loss, true, but it is a slight improvement from negative 44 cents last quarter. You have to understand that with blast furnaces, your fixed costs are basically a giant anchor. When you run them light, it destroys profitability. But they got volume back this quarter. They shipped over 4.1 million tons. So when that utilization ticks up, the leverage really kicks in. The real story is adjusted EBITDA. They clawed out a positive $95 million. That is a massive recovery from the $21 million loss in Q4.
And that $95 million is with the freak winter storm factored in. Management said that extreme weather caused a natural gas and electricity spike that cost them, exactly $80 million in EBITDA. If you add that back, the quarter actually looks incredibly solid.
Exactly. The core business is functioning. Average net selling price bumped up over 5% sequentially to $1,048 a ton. So they're getting better prices and moving more metal, heavily driven by automotive demand pulling them forward.
Speaking of moving metal, I loved the little operational detail the CEO dropped about their production planning. Did you catch the part about Microsoft Excel?
Yeah, the human limit.
Yes, a multi-billion-dollar heavy industry giant admitting they literally maxed out what humans can do with a spreadsheet. They're bringing in an AI partner for order sequencing just because the math got entirely too complex for human brains to handle without creating logjams.
I mean, it is funny, but it really shows where they're at operationally. You reach a certain scale where dragging and dropping supply chain cells just bleeds margin. It's a completely necessary tech upgrade for an old school business.
Completely. All right, so the headline numbers are surprisingly resilient, but there are some really messy cash flow dynamics under the hood and a bizarre situation happening with their pricing up in Canada. Let's get into the details.
So picking up on that Canadian pricing situation, you look at North American steel and you generally just assume it is one big, relatively unified market. But right now, Canadian spot pricing is running at this massive 40% discount to the U.S.
40%? That is not just a little geographical basis risk. That is a completely disconnected market.
It is entirely detached from reality. The CFO actually explicitly pointed this out on the call. He said, quote, "In today's market, the Canadian selling price is at a 40% discount to U.S. pricing, which historically is just, well, a complete anomaly."
So what is breaking the market up there? I mean, they just bought Stelco late last year, so they obviously have a ton of exposure to Canadian spot pricing right now.
Right. Stelco sells almost exclusively on the spot market. And what we are seeing is basically the unintended consequence of U.S. trade policy. You have the Section 232 tariffs keeping cheap foreign steel out of the States, so all that excess global supply, it just gets routed around and dumped into Canada instead.
Oh, wow. Okay, so Fortress North America basically has a giant backdoor left wide open.
That is a very accurate way to put it. Until Canada gets its own tighter trade policies in place, that foreign dumping just heavily erodes the local margins for a company like Stelco.
And that actually brings us to the cash flow, because I saw their operating cash flow was negative $325 million, and then CapEx pushes the free cash flow proxy down to almost negative $500 million.
Right, negative $477 million total.
Which sounds terrible on the surface for a company talking about an earnings recovery.
Well, you have to actually parse out the working capital build there. $130 million of that was purely working capital getting tied up. They had very strong shipments and pricing late in the quarter, particularly in March. So their accounts receivable just surged. The cash is essentially caught in transit. Plus, Q1 is naturally when they pay out their standard high-yield bond coupons.
Okay, so it's really a timing issue. It's not a fundamental operational bleed.
Mostly timing, yes. But I will say the cost side has another quirk that I found interesting. They entirely stopped hedging their diesel exposure.
Wait, why would you do that?
Heavy industry practically runs on diesel.
Their rationale is that since they transitioned purely to a steel company, they really only need to hedge natural gas now. But the unhedged diesel is hitting them for, I think, about $50 million a year in mining costs. It is roughly $6 a ton. It leaves them structurally exposed if geopolitics blow up oil prices later this year.
Well, speaking of geopolitics and changing industry dynamics, there is one narrative from the CEO that I thought was absolutely fascinating. The whole death of the aluminum auto dream.
Oh, yeah. Lourenco was practically taking a victory lap on that one.
He really was. He said, quote, "In my long career in this business, I have never seen so much momentum in substituting aluminum with steel." And this is so interesting because automakers originally pushed for all this lightweight aluminum to try and match Tesla's EV designs. But they ran into insane supply chain headaches and massive assembly costs.
Right, because aluminum is notoriously finicky. It is much harder to stamp and weld compared to steel.
Exactly. And now they are walking it all back. Auto OEMs are taking the exact same stamping equipment they originally bought for aluminum and literally just running Cliff's advanced high-strength steel right through those lines.
It is a massive win for legacy steel. You get the safety and the rigidity without the fragile supply chain. And the fact that they can reuse the aluminum stamping lines, I mean, that is the exact kind of capital efficiency automakers are desperate for right now. They even just won a major quality award from Toyota, which has arguably the strictest standards on the planet.
Which really proves they nailed the recipes for that high-end auto sheet. They are not just turning out cheap commodity coils anymore.
Nope, they are not. And they also freed up a lot of capacity by finally letting that old margin-dragging ArcelorMittal slab contract expire. That was a legacy contract taking up... Well, actually, the final shipments were around 175,000 tons this quarter. Now they can route those same tons into these higher value, much more profitable automotive products. It fundamentally upgrades the entire product mix.
Okay, so they're selling a higher quality product to eager automakers, but they're also dealing with weird localized pricing discounts and zero diesel hedges. So where does this leave their actual profitability heading into the summer?
Well, the math for Q2 is actually pretty compelling. Management is guiding for selling prices to jump about $60 a ton, and that completely masks the roughly $15 cost tick-up they're expecting.
Wait, costs are still going up? I thought we were past the messy winter stuff.
Just slightly, yeah. It is mostly that unhedged diesel exposure and some planned facility outages. But because of the incredible price leverage, the CFO basically claimed Q2 should be their best quarter in nearly 2 years for both EBITDA and cash flow.
Wow, 2 years. That is a wild pivot from taking an $80 million weather hit to the face.
It really is. And then Q3 is supposed to be the quarter where costs finally drop meaningfully because those outages wrap up, assuming the steel price curve holds, of course. That is the eternal asterisk here.
Right. It's always a giant asterisk with commodities. But it does sound like they are setting up a really aggressive second half of the year. So what are the actual speed bumps left to watch?
2 big ones. First, you have the United Steelworkers labor negotiations coming up. Union talks are never a guaranteed smooth ride. And second, that whole POSCO joint venture they made such a big deal about last quarter is stalled.
Oh yeah, the big regulatory moat project. What's the holdup there?
pure geopolitics. With all the recent disruptions in South Korea, the CEO frankly admitted, quote, "It is clear that things are a lot more complicated."
Fair enough. Between South Korean politics and having absolutely zero diesel hedges, they are definitely leaving themselves exposed to the global news cycle.
They are. They survived the literal winter storm, so now it's really just about executing the summer volume without stumbling.
And praying the world stays quiet for 6 months.
Exactly, which is always a bold strategy.
Good luck to them on that. Well, I think that paints a pretty clear picture for Cliffs this quarter. Thanks for tuning in today, everyone.
Catch you next time.
If you want these earnings breakdowns to just automatically show up in your feed, you can go ahead and follow the podcast. And just as a reminder, we do put this together with a little help from AI to quickly read through all those dense SEC filings. If you have a specific ticker you want us to dig into next, just shoot us an email at earningsunscripted@datamadness.ca, and we will catch you next time.
See you out there.